Hi, Lewis. How are you doing?
I'm good, Diana. How are you?
I'm good. Excited to have you here today. Kindly introduce yourself to our audience and tell us briefly what we are going to be touching on today.
So, my name is Lewis Ndonga, and I'm an associate at FMC Advocates. And today we'll be looking at a very interesting discussion on capital markets, really with the goal of understanding how capital markets work, how really the players within the space, and some of the key considerations that somebody who is looking in investing using capital markets, what are the kind of things they need to think about when making some decisions in capital markets. So it'll be a fun conversation, and I hope that our audience really learns a lot from this conversation. Yeah, yeah.
Okay, thanks. Maybe just to jump right into it. When we hear capital markets, personally, the first thing that comes to mind is Nairobi Stock Exchange, which is
Yeah.
the public. It's what we use to trade here in Kenya.
Yeah.
So maybe if you can debunk what capital markets is, that would be a good place to start.
Yeah, definitely. So really, capital markets are it's sort of a system where people trade in financial assets with the intention of really benefiting or getting some form of profit or financial benefit from this trading. And this is usually done mostly through the public. So of course, as perhaps we have seen or we will see in majority of our series in these videos, there are certain other kinds of investments like venture capital and private equity. And the very key distinction between that and what we're discussing today is who we are dealing with. In capital markets, we're really dealing with the public. Anyone is invited to invest, everyone is ready, anyone who is ready and willing to invest can actually just do so and come in and invest whatever system that they feel they're more comfortable with, they are open to do so. And because of that public nature, it's then governed by an actual statute and an actual law called the Capital Markets Act, with the intention of protecting the public, because this works really differently from the other kinds of private investment schemes. So from a at a very bare minimum, it's a system of trading of financial assets. It really involves both equity investment and debt investment. Maybe just to gloss over and maybe give a very brief definition of the two. So of course, equity investment is at a very minimum level, buying into the control and ownership of an existing entity or a publicly trading entity. So this is of course mostly done in Kenya, as you've said, through the Nairobi Securities Exchange, by buying and selling or trading of securities. So that trading of and exchanging of what Americans would call the stocks, yeah, that's what is part of the capital markets. Specifically, again, with debt investment, again, is a system where investors give loans to existing trading entities or even to government entities, of course, with the intention of, at a certain point in time, getting some form of financial benefit at the very end. So this space is a very key space for the general public, people who are really looking at investment ideas, trying to get something that's more different and unique as an investment system. And a very key characteristic is how long-term they are. Is this something that you invest for a long period of time, as opposed to some short-term investments that we see in the country? Capital markets can be done for a very long period of time. And due to the statutory regulations, due to the laws that are in place and the bodies like the Capital Markets Authority, the public is really protected and has some sort of incentive to get into capital markets. So that's how, as a very bare minimum, I would really define capital markets. Yeah.
Thank you for kind of setting the tone with that. I think when you were just talking about that, I remember the conversation we were having with another colleague, and I think there was mention of primary markets and secondary markets, and I was hoping maybe you can give us a bit of insights into that.
Yeah, definitely. So a key aspect of the way the capital market system works is the use of a primary market and secondary markets. So a primary market is really the initial offering or the initial market in which entities offer their financial assets. So a good example is what we call an initial public offering. So where a company goes public, they normally offer their shares or their stocks to the public for the first time. So at that point, the trading entities is an investor who's coming in to buy the stocks, whether individually or through certain entities or corporations that work within the space, or as on the one hand, and on the other hand, we have the now newly publicly trading entity. So a primary market is a situation or it's a system where the entity, a publicly trading entity, offers its securities, mostly in this case would be shares, for the first time to the general public. This is where investors and entities trade together. But a secondary market now comes in. What happens later? When somebody buys, for example, when somebody buys stocks in, let's say, in Safaricom, after some time they feel like they've gotten the benefit they needed, or they're no longer willing to hold the shares. They can now trade. They can now sell these shares to another interested investor. That's a secondary market, where now investors are now trading with each other or trading within certain investment schemes with the idea of getting a certain kind of benefit, of course. So in this secondary market, the publicly trading entity is not involved. They are not, once they have already issued their shares, well, how they move to the secondary market is really determined from the value, the market value and profitability of the entity. At initial public offering, the company will determine, of course, we will say that we're offering out the stock at a certain price. As time continues and as the publicly trading entity determines profitability and how its shares are doing, stocks are doing on the NSC, that's how the secondary market comes in. And that's where you see sometimes the prices will keep fluctuating, where people will be buying and selling shares at very different rates over different periods of time. So those are kind of the markets where people or investors in capital markets are engaged in. People who come in at the initial the primary market stage can really benefit very, very greatly, especially where a company really just goes public and does really, really well and becomes very profitable over a period of time. Shares that you had initially gotten or that were initially offered to you at a previously determined price by the publicly trading company have now moved to a more profitable and to a higher price, which you can then determine on how best you would gain from that. And I think later on we'll have a discussion on really the benefits or the gains for trading within the capital markets. So yeah, that's what we mean by primary markets and secondary markets. Yeah.
Thank you for clearly distinguishing those two. So initially you had talked about equity investment, and I know, or I think later in this series we'll discuss private equity in detail. But how does equity investment come in capital markets where these are like publicly traded shares?
Yeah, so for this now, here is where we now try to distinguish from private equity and venture capital. The idea being, who is the intended investor? Who are we trying to get on board for a publicly trading entity? Who is it trying to bring on board? It's trying to bring on the public. Anyone who is interested or anyone who is willing to invest in these kind of companies, they really come in at that stage and they really come in to just invest and inject capital into some of these businesses. And this is where, again, the conversation of primary markets, secondary markets are still key. Because on our primary markets, specifically with equity investment, you find companies will offer out their shares. Because equity investment, like we defined it before, is really the trading of a controlling stake or decision-making stake in a publicly trading company. So with equity investment, investors come in to buy securities, stocks, shares, so that they can get a certain level of control and also get a certain level of financial benefit as being a member of this publicly trading company. And again, primary market, secondary market. In the primary market, an investor will come in and get shares at the very beginning, offered to them at a predetermined value, and they buy the shares at that point, and they then, of course, gain the level of control and decision making and are entitled to certain rights as a shareholder in the company. And then under the secondary market, somebody who would then purchase stock from somebody else who already was owning stock. So that's where now these values are different. These are determined by the profitability of the company. You'll find a company like Safaricom or another very, very big company has their margins or the profits or how much they're selling their stocks is very different from other companies. So, and that's where the secondary market comes in. All of this is done, of course, within the confines of the NSC. They're the ones who really now give the platform, I would say, the platform for trading between investors so that they can actually manage to buy and sell shares within a capital market system. Of course, I think another thing that's also really, really important to discuss is why consider the equity investment, and it's really twofold. First, let's maybe look at the publicly trading entity. Why would they even consider giving an initial public offering? And if you look at a usual, let me say, the life cycle of successful entities, successful companies, where they start off from the venture capital or the startup phase, where they're now doing venture capital. They're trying to get people on board to, quote unquote, believe in the dream. So when you move past that stage where now the dream is now starting to actualize, you're starting to have some footing, people are starting to know who you are, people are starting to identify your products or what you're giving to the market, it becomes a natural next step for you to offer your shares or your stock or your level of control publicly to anybody who is willing to invest. The really big consideration, of course, for these kind of companies is getting capital. It's really additional capital in their system. It's additional funds for them to continue with their business and to continue running and potentially to increase their profit margins. On the flip side, for an investor, somebody who is trying to come in and invest in equity, one of the I think I would say there are two very key considerations. The first one is, of course, dividends or distributions. The legal, of course, landscape in Kenya that a company can only issue out dividends from the profits means that where companies are profitable and they're actually making profits within a specific financial period, then the shareholders of that entity can benefit on where they get their dividends or their distributions, depending on the ratio of their membership or ownership in the company. Inversely, when we move towards looking at the secondary market, anybody who sells shares to another investor, somebody who bought shares at an initial public offering at, say, 2 shillings per share, and then sells them for 10 shillings per share, gets a capital gain from the initial point of purchase to the point of sale. There's a capital gain of which people are very, very interested in, and it can really be a very lucrative kind of investment. So yeah, that's really how we would define equity investment.
Thank you, Levis, for giving us that insight into equity investment. I think, or rather, the question that I have top of my mind is whether there's a place for debt investment in capital markets, and if so, how that operates in that particular space.
Yeah, definitely. I think debt investment has always been a very, very important consideration in this country, on both for government entities and even for private entities, as a means of pushing the profitability, of pushing as a form of capital injection. Debt investment has always been a very key consideration, and that's why for capital markets we have things that are called bonds. So bonds are the most common, they're the most common form of debt investment, specifically with capital markets. And there are various forms of bonds within the capital market sector. And the first one is treasury bonds. So this is now where the government comes in and then offers bonds within a fixed term and of a fixed rate, where they come in and basically they say that we are offering the bond to the public of a certain amount. It's going to run for a certain period of time. It's going to mature, as they normally say, within a specific period of time. If you're interested, you can come. You would ideally just loan us the money. Then when in the maturity period lapses, you get your money back. You get your money back, and of course there is the interest on top that would, of course, work as incentive for anyone who would seek to invest within a treasury bonds. So yeah, these are issued through by the government of Kenya through the CBK, or the Central Bank of Kenya, with the intention of having people come in and just invest in the government to allow for the government to take on certain projects. They are very, very common. They are always around, and there's a minimum. I believe there's a minimum amount that you can invest with treasury bonds. Inversely, again, also private, other than government entities, non-government entities also want and need to continue with debt investment as a form of bringing in capital to their business, which is where corporate bonds really, really come in. And corporate bonds are where entities, publicly trading entities, offer the same way as the government offers bonds of a specific or fixed term and of a fixed rate, where they say that we're offering this bond for a certain amount. Anybody who is interested can come in, invest with us. Once the maturity period lapses, of course, you get your money back. And of course, there is the interest rate that was previously agreed. There are some, of course, with corporate bonds, there are now some limitations, or there are some requirements in law. One of the very key ones is that you need to have been profitable for 2 of the last 3 preceding financial years. And this is where it really goes back again to the kind of, I would say, characteristic of capital markets. The intention is to protect the public. The intention is that the regulators within the space have to say, we need to make sure that anybody who invests within a capital markets is protected. So by doing so, there are a flurry of requirements that the capital markets and the NSE has, requiring for entities to actually give out corporate bonds. But one of the very key ones is that in your financial statements, it should be clear you've been making a profit for at least 2 of the last 3 preceding financial years. A very, very interesting one is green bonds. Now, this is something that has really come up with the new emerging issues of climate action, environmental conservation. And this is something that has come in with the intention of trying to promote environmental conservation, which is why, again, non-government entities are also offering green bonds with the intention of, or really that green bonds are used for projects that are meant for environmental conservation or climate change mitigation. And these are they're really starting to take ground in the country. As of now, I only know of one which is being offered by Econ Holdings, which is being given out to investors who would feel that they are more keen on only investing in projects that have an actual positive benefit towards environmental conservation. So again, but they more or less comply with the same characteristics really with bonds over a certain period of time, and they have a fixed maturity rate. And there's something that really for those of our viewers who are really interested in environmental conservation and they feel they want to take an active step in doing so, then they can really consider investing in green bonds. Yeah.
Thank you. I think that's quite interesting to hear, and even to hear the fact that how the space is evolving to even take into consideration issues such as climate change and financing for such projects. I'm curious to find out who are the key stakeholders within the capital markets, and what roles do they play.
Thanks so much, Dan. I think I would break it down into two. I would start first with the government. Of course, the government will be involved considering the very public nature of the capital market sector. So there is a lot of regulation within this space. There are entities like the Capital Markets Authority, which is the main regulatory authority within the capital market sector, intended on ensuring safety and security within the space, that the people who are investing in capital markets are safe and they're secure. And of course, licensing and regulating people now who want to trade, publicly trade, even those who want to, for example, another example of a capital market is a collective investment scheme. Most commonly, most people will know them as money markets. So again, some of those people are also regulated by the Capital Markets Authority. We also have an entity called the Central Depository Settlement Corporation, or CDSC. CDSC is also works under the Capital Markets Authority to now give a central system where everyone who would wish to invest in capital markets, they all come here. They all come to the CDSC, open an account, and everything is channeled towards in one central depository, which also makes it easy to just prevent people who would want to take certain nefarious ways to try and invest. Even things like anti-money laundering, it's also a very good way of preventing that. So the government is really very proactive in this space. On the inverse, in the private sector, or on the other end, non-government entities, of course, we have the public trading entities themselves, the companies. We also have pool fund managers. Like I've said, we have other forms of capital markets like collective investment schemes like money markets or real estate investment trusts, which have also become pretty common, both income and development real estate investment trusts. These people who come in and pool everyone's money together and invest it in one sort of vehicle. These people are also very key within the space. Also, we have brokers, people who come in, the middlemen who come in at the secondary market to just assist people who want to trade, are also very key, very key stakeholders. Again, of course, lawyers are also involved from the setting up stage, moving towards the public offering, making sure the documentation within that space is in order and compliant with the legal provisions. As perhaps many of our viewers would be aware, the publicly trading entities are now governed by a very separate area of corporate law compared to the private ones. So lawyers are also very key stakeholders within the space. Yeah.
Okay, that's interesting to hear. Quite a number of stakeholders within that particular space. What would you say are like the emerging trends in this particular space, or what are your key takeaways from operating in this particular space?
Yeah, I think capital markets have really grown and tried to move with certain levels of innovation. I've just talked about the green bonds, which is really something that's new. We wouldn't really say that it's something that's been there. So moving towards this kind of new areas with green bonds, with real estate investment trusts as well, they've really taken a grip in the country with some of we've seen some of the development real estate income trusts and even the income real estate trusts have really come in to just give an alternative means of investment, which is what in my view, as a country, and many people in this country need an alternative means of investment. When majority of Kenyans are growing up, they are taught to invest in specific areas, but that's not always how it works, because if an entire population moves within one system of investment, then the profitability of that investment ceases. So I feel that the alternative options that we have out there, for example, with green bonds, with rates, and Kenyans have really taken up money markets. They just show that Kenyans actually know what this is, and in my view, we can only expect an upward trend in the growth of the capital market sector. And I think as lawyers, we're really interested in seeing how far and how much we can see this grow as a country. So yeah, I think that would be my takeaway.
Okay. Thank you so much, Lois, for taking the time to be with us today and, enlighten us on, capital markets. Truly appreciate your insights and your contribution towards this particular topic. Hopefully we'll see you more often on this particular platform.
Great. Thanks so much, Diana, for having me, and I hope our viewers have really learned a lot on capital markets.
Okay.
All right. Thank you.